Okay, so real quick. If you are between 60 and 70 years old, or if someone you love is in that age range, I need you to stop whatever you're doing right now and watch this entire video, because what I'm about to share with you could literally save you or someone in your family thousands of dollars this year. I'm not exaggerating. The IRS just dropped updated guidance in early 2026, specifically affecting retirees in this age group. And the scary part is that most people have absolutely no idea this happened. Your financial advisor might not have even called you about it yet. And I'm going to prove that to you right now with a real example. A guy named Robert, 67 years old, retired school teacher from Ohio, been doing his taxes the same exact way for 11 years. He came to his accountant this past April 2026, thinking everything was fine, same routine, same deduction, same process. Walked out of that office owing $200 more than he expected. Not because he did anything wrong, not because he cheated, but because the rules changed and nobody told him. That's exactly why you're watching this video today. So if you don't want to be the next Robert, hit that like button right now so YouTube keeps showing you this kind of content. And let's get into exactly what changed, why it affects you, and most importantly, what you can do about it before December 31st, 2026. So let me give you the big picture first before we get into the specifics. The IRS doesn't exactly send you a personal letter when they update the tax code. They publish it in documents that are honestly written like they don't want normal people to understand them. But here's what happened in 2026. A combination of updated required minimum distribution rules, changes to how certain retirement income is calculated for tax purposes, and adjustments to the standard deduction thresholds for older adults all came together at the same time. And when three things shift at once, the people who get hurt are the ones who assume nothing changed because nothing changed last year. That assumption right there is what's costing retirees real money right now in June 2026. Let's talk about required minimum distributions first, because this is where most people between 60 and 70 are getting confused right now. If you have a traditional IRA, a 401k, a 403b, or really any tax-deferred retirement account, the government has always had rules about when you have to start taking money out. For a long time, that age was 70 and a half, then it moved to 72, and the Secure 2.0 Act pushed it again. But here's the thing that trips people up in 2026. The age change doesn't mean you're off the hook. What it actually changed is the calculation table the IRS uses to determine how much you have to take out each year. The new tables are based on updated life expectancy figures, which sounds like good news, and in some ways it is because it means slightly smaller mandatory withdrawals for some people. But if you're already taking distributions based on the old calculation and you haven't updated your math going into this year, you might be taking out too much. And that extra money you're pulling out is taxable income. You're paying taxes on money you didn't have to take yet. Now here's where it gets even more nuanced, and this is the part that even a lot of financial professionals aren't explaining clearly right now in 2026. If you're in that 60 to 70 window and you haven't hit your RMD age yet, you're actually in what I call the golden window. This is the period where you have the most flexibility and also the most opportunity to make decisions that will affect your tax burden for the rest of your retirement. The moves you make right now in this window determine how much of your Social Security is taxable later. They determine what Medicare premium bracket you fall into. They even affect how much of your investment gains get taxed. Most people treat this phase of their retirement like a waiting room. They're just sitting there waiting to hit the age where they have to start taking distributions. And while they're waiting through 2026 and beyond, they're missing enormous opportunities that may not come back. Let me give you a concrete example of what I mean. Say you're 63 right now in 2026, you've got a traditional IRA worth $800,000. Your income right now is relatively low because you're semi-retired or fully retired and living on savings or a small pension. Your taxable income this year might put you in the 12% federal tax bracket. Here's the thing. You could voluntarily convert some of that IRA money into a Roth IRA right now in 2026, pay 12 cents on the dollar in taxes, and then that money grows completely tax-free for the rest of your life and never has any required minimum distributions attached to it. But if you wait and do nothing, when you hit your RMD age, you might be forced to take out so much money that it pushes you into the 22 or even the 24% bracket. You went from having a choice to being forced. The IRS didn't do that to you. The lack of planning did. And again, this is not some obscure strategy that only wealthy people know about. This is in the tax code, it's legal, it's encouraged, and millions of Americans in exactly your situation are leaving this on the table every single year because they simply don't know about it. Now let's talk about Social Security, because I know a lot of you watching this are either already receiving benefits or about to start. The taxation of Social Security is genuinely one of the most misunderstood parts of the entire tax code. A lot of people think Social Security is tax-free. And when they were told that years ago, it might have been mostly true for their income level. But here's the reality in 2026. Up to 85% of your Social Security benefit can be taxable depending on what the IRS calls your combined income. And combined income is not just what you earn from a job. It includes your adjusted gross income, any tax-exempt interest you receive, and half of your Social Security benefit. So even if you're doing everything right, if you're pulling from the wrong accounts at the wrong time right now, you can accidentally push yourself into a situation where you're paying taxes on your Social Security when you didn't have to. The IRS changes we're talking about today interact directly with this formula, and that's why acting before the end of 2026 matters so much. There's also something that not enough people are talking about right now called IRMAA, Income-Related Monthly Adjustment Amount, and it's basically a Medicare surcharge. If your income in a given year crosses certain thresholds, your Medicare Part B and Part D premiums go up significantly. And here's the brutal part. They look at your income from 2 years ago to calculate this. So a large IRA withdrawal you took in 2024, maybe you needed a new roof or you helped a kid with a down payment, that decision is affecting your Medicare premiums right now in 2026. The thresholds were adjusted again this year, and the brackets shifted slightly, which means some people who were just barely under the surcharge threshold before are now sitting right on top of it or over it. This is one of the specific changes in this latest IRS update, and it's one that almost nobody is paying attention to as we sit here in June 2026. I want to take a second and talk about something a little more emotional here, because I think sometimes when we talk about taxes, we lose the human side of what this actually means. People who are 60 to 70 right now in 2026, a lot of you worked for 35, 40 years. You sacrificed, you saved, you did what you were supposed to do. You believed that if you played by the rules, you would be okay. And then you get to this chapter of your life and you find out the rules changed and you didn't even get a memo. That's not fair. And I'm not here to tell you the tax code is fair, because honestly, a lot of it isn't. What I'm here to tell you is that knowing the rules, even the new ones, even the inconvenient ones, is how you protect what you spent a lifetime building. Knowledge is the only real tool you have here, and that's exactly why I make these videos. Let's get into one more major area that changed. And this one specifically affects people who are still working part-time or doing any kind of consulting or freelance work in their 60s right now. The rules around how earned income interacts with your retirement distributions have been updated for 2026. This matters more than you might think, because a lot of people in their 60s are doing what's called semi-retirement. They might be working 20 hours a week, making $30,000 or $40,000 a year, and also drawing from their retirement accounts at the same time. The interaction between earned income and retirement income is something the new IRS guidance specifically addressed this year. And depending on your situation, it either works in your favor or creates a tax trap. If you're in this group, you really need to look at how your income sources are stacking up against each other right now, because we're already in June 2026 and the year-end planning window is closer than you think. Now I want to make sure you leave this video with something actionable, because information without action is just entertainment. So here's what I want you to actually do after you finish watching. First, figure out your projected total income for the rest of 2026. Not just your paycheck or your pension, but everything. Social Security, retirement account withdrawals, investment income, any side work, all of it. Get a real number. Second, look at what tax bracket that puts you in, and then see how far you are from the next bracket up. That gap is actually an opportunity. If you're $15,000 away from moving into a higher bracket, you might have room to do a Roth conversion or take a strategic distribution and pay a lower tax rate on that money now than you would later. Third, and this is the most important one, have a real conversation with a CPA or a fee-only financial advisor before December 31st, 2026. Not a tax preparer. A tax planner. There's a massive difference. A tax preparer files what happened. A tax planner helps you shape what's going to happen. The planning window for the 2026 tax year closes December 31st, and it never comes back. The people who come out ahead in retirement aren't always the ones who earned the most or saved the most. They're the ones who paid attention at the moments when attention mattered. Right now, in June 2026, with these new IRS changes already in effect, is one of those moments. You are in the golden window. The decisions you make this year and over the next few years in this 60 to 70 age range will echo through the rest of your retirement. That's not meant to scare you. It's meant to empower you because you are still in time. Robert from Ohio wasn't proactive. He assumed nothing changed heading into 2026. You watched this video. That already puts you in a completely different category. If this helped you today, share it with someone you know who's in this age range. Because the best thing you can do for someone you care about is make sure they have the information they need before the damage is done. Subscribe to this channel if you haven't already, because I cover these tax and retirement topics regularly in plain language that actually makes sense for real people. And drop a comment below telling me what state you're in. I'm genuinely curious how many of you watching this in June 2026 are also dealing with state-level retirement taxes on top of these federal changes, because that varies dramatically depending on where you live, and we may do a dedicated follow-up video on exactly that. I'll see you in the next one.